So, what if you could trade the market not with guesswork, but with the dead-on precision of a sniper? Today, we're going to break down a systematic model that's all about turning market chaos into a clear, repeatable process for finding those high-probability entries.
You ever had that feeling? You're staring at a chart and it just feels like the market is actively, personally working against you. You know that gut-wrenching moment when you get stopped out by a single tick, only to watch the price immediately reverse and just rocket in the direction you knew it was going to go? It feels personal, almost like it's rigged.
Now, this quote from our source material, it's intense, right? But it completely reframes how you should look at the market. The idea here is that for a really good trade to even exist, somebody else has to be on the wrong side of it. They have to be trapped. So this isn't about predicting the future, it's about spotting the trap.
So what if the market isn't random at all? What if it's actually a super efficient machine that's designed to do one thing over and over again? Well, according to this model, that one purpose is to hunt for liquidity. This is the big secret, and once you get this, it can totally shift your entire perspective on trading. So what is liquidity? Well, in the simplest terms, it's just a giant pool of orders. Think about all those obvious places where retail traders are told to put their stop losses or their breakout entries. For the big institutions, what we call smart money, these pools of orders are like a gas station. They need that fuel to fill their massive positions without sending the price haywire. The million-dollar question then is, where do you find these pools of fuel? Well, they pile up in the most predictable, textbook places you can imagine, right below equal lows or just above equal highs, at those super obvious support and resistance levels, or after a trend line gets touched a few times. These are the exact spots retail traders put their orders, and that is precisely where smart money goes hunting.
Okay, so now that we've got the what and the why, let's get into the fun part, the how. The source material lays out a really clear four-step sequence. This isn't about feelings or guesswork. It's a framework, a checklist, designed to spot a very specific series of events on the chart.
And here it is, the sniper sequence. It's 4 simple steps. First, you need a sweep of liquidity. Second, you look for a confirmation of the reversal, which is called a change of character, or CHOCH for short. Third, you identify your high probability zone, known as a fair value gap. And finally, the patient execution of the entry. Let's break each one of these down.
Step 1 is all about the sweep. This is that initial, aggressive move where the price pushes just past a key level, triggering a whole flood of stop-loss orders. This is the moment the trap is sprung. It's perfectly designed to suck in eager breakout traders and to shake out anyone who's already in a position.
Okay, this right here is probably one of the most critical distinctions you have to make. A liquidity sweep is a fake-out. You'll see the price spike through a key level and then snap right back inside the range, often leaving a long, angry-looking wick on the candle. A real breakout, on the other hand, shows strength. You see big, full-bodied candles closing and actually holding beyond that level. Confusing these two is one of the fastest ways to lose money.
So, once the trap is set, you need confirmation that the reversal is for real. That's where step 2 comes in, the change of character, or CHOCH. This is your very first signal that the market structure has actually shifted. So for example, after sweeping a low, the COCH would be the first clean break of a recent little high. It's your evidence, your green light that the tide is officially turned.
Now, after that change of character, the aggressive move that caused it often leaves behind a clue, a footprint. We call this a fair value gap, or FVG. It's this little 3-candle pattern that creates an imbalance in price, and it's basically a signature of heavy institutional buying or selling. This FVG becomes your high-precision entry zone, because the market just loves to return to these areas to rebalance before it continues its new move.
And that brings us to the final step, the entry. And this is where that sniper mentality is absolutely crucial. You don't chase the price, you don't jump in out of FOMO, you patiently, calmly, wait for the price to come back to you, to return to that fair value gap. This disciplined waiting is what gives you that beautiful, high-reward, low-risk entry point.
So, you found the setup. The whole 4-step sequence is there, it's perfect. But you know, a great setup is completely useless without disciplined execution. This part is all about managing the trade the right way to protect your capital and, actually get paid.
This might just be the most important rule in this entire model. And the source material is dead serious about it.
You risk a maximum of 0.5% of your account on any single trade, period. Trading is not about getting rich on one big hit. It's about survival and consistency. This single rule is what keeps you in the game long enough to actually win.
Taking your profit shouldn't be an emotional roller coaster. It should be systematic. A really simple and effective strategy is to take your first profit when you hit a 1-to-1 risk to reward. The second you do that, you move your stop loss to your entry point. Boom! The rest of the trade is now completely risk-free. Then you can look to take some more off the table at 1-to-2 and let the rest run towards the next major liquidity pool.
Look, having a technical model is one thing, but executing it flawlessly day in and day out, that requires a very specific mindset. This is the stuff that separates the consistently profitable traders from the 99% who just spin their wheels. It's all about discipline, patience, and knowing what not to do. According to our sources, these right here are the account killers. Jumping into a trade without a confirmed liquidity sweep, chasing price out of FOMO instead of just waiting for your entry, forcing a trade when the setup isn't crystal clear, and of course, trying to trade in those choppy, sideways markets where it's impossible to tell what's going on. Just avoiding these common mistakes can dramatically improve your results.
So after going through this whole model, it really all comes down to one simple question. A question you should ask yourself every single time you look at a chart. When you place your next trade, ask yourself this: are you hunting the liquidity or are you providing it? Are you the sniper or are you the target?